Many of the reflexes that we innately have were really helpful when we were faced with predators like saber-toothed tigers in the Stone Age. But it turns out that evolution hasn't prepared us well for facing the market economy. When we take these same reflexes and apply them to our finances, they push us to make bad decisions. In today's episode, we're going to look at why our behavior, or more precisely, our behavioral biases, make us really bad investors. So let's start with an example of the anchoring effect. A study was conducted by German psychologists Fritz Strack and Thomas Musweiler, where they asked the first group of participants if Gandhi was older than 9 when he died. They asked the second group if Gandhi was younger than 140 when he died. Both questions are obviously ridiculous. When the two groups were subsequently asked to guess the exact age Gandhi was when he died, the first group's responses averaged 50 years old, while the second group averaged 67 years old. This is a great example of the anchoring bias. When we hear any number, even if it's completely unrelated, any subsequent judgment we make will be influenced by the previous number we just heard. Just think about all the numbers we hear every day in the news and how this is messing with our perception and judgments. Another great reason you're not a rational investor is what's known as the endowment effect, where we value items more when we already possess them as opposed to when we don't. The mug experiment by psychologist Daniel Kahneman and economist Richard Thaler really demonstrates this effect. In this experiment, participants were given a mug, and they were offered the chance to sell it or trade it for pens. The newly minted mug owners wanted twice the number of pens to sell their mug as compared to the pen owners were willing to offer. In other words, participants' willingness to pay was much lower than what they were willing to accept for the same item. This bias goes against standard economic theory. The endowment effect says a lot about why we have a tendency to hold on to losing stocks in the hopes that they'll recover, even if this is completely irrational, in the same way that the participants overvalued their mugs. Now, these are just two among many of the biases that we have that make it more difficult to make clear and rational judgments about our money and our investments. Combined with the arguments we went over in my previous videos about why markets are efficient, don't you think this makes a convincing case for being a passive investor? Please, leave me a comment if you agree or disagree. I want to hear from you. Thanks for watching, and as always, don't forget to subscribe to my YouTube channel if you want to team up and look for investing topics together.